Hi everyone, my name is Henk Heymans. I'm the Head of Audit at RSM South Africa, and I'm responsible for our quality and risk issues in South African practices of RSM. I'm going to talk today about the Brydon report that was issued in December 2019. But first, a bit of background. The best background is probably in the beginning of the Brydon report itself, where Brydon quotes from The Guardian, a publication in April 2019, where the newspaper said the auditor's failure to spot the fragility of those businesses resulted in the loss of jobs, savings, pensions and tax revenues. Okay, so here Brydon is referring to the failures, much publicised failures in the UK of the Carillion Group and the Patisserie Valerie Group, where they say, the newspapers say, that the auditors failed to spot the fragility of those businesses, and that resulted in the loss of jobs. Now that is obviously very debatable, but you can see from the statement that that is the starting point of the Brydon report. The auditors had to spot the fragility of those businesses. Brydon followed on a couple of previous reports from also in the UK, notably the Kingman report dealt with some issues where the regulator could be improved. There was the Competition and Markets Authority report, there was a report from the Bay Select Committee, and then Brydon was asked to investigate the quality in audit work. Brydon called for views in April 2019 and then finally issued their report in December 2019. The main change in the Brydon report that they are recommending is they're recommending a new definition for an audit. I'm going to put that definition up on the screen now, and it's quite important to read through it very carefully. Brydon recommends that an audit be defined as the purpose of an audit is to help establish and maintain deserved confidence in a company, in its directors and in the information for which they have responsibility to report, including the financial statements. Okay, so there's a few new things there. First of all, the purpose of the audit is to help establish and maintain deserved confidence. The auditor was never supposed to help establish and maintain deserved confidence. The confidence is something for the directors, and the auditor's duty was always just to establish the credibility of the financial statements. Now we're talking about confidence in the company. That's extending it a lot. And its directors and the information for which they have responsibility. Not only the financial statements, but including the financial statements. It does say that the primary responsibility still lies with the directors, but it's important here to note that Brydon recommends that the auditor should be given the task to help establish and maintain the deserved confidence in the company. If we can just look at that statement again, that auditors have to look at the information on which the directors report, including the financial statements. So Brydon is now implying that the information is going to go wider, and it may even include new information. That's a whole new distinction that we have here. Auditors are always only used to report on information that the directors have reported. So the directors report something in the financial statements and the auditors express an opinion thereon. Brydon is now saying that it may actually have to go wider, and the auditors are expected to even provide new information. So where the directors are not providing the information, the auditors actually need to add it. There's still no obligation on the auditors to go and find the new information. It's only if they find something during the course of their duties. So they don't have to go and look for other information, but obviously while they are auditing financial statements, they look at other documents as well. And if there's any information in that documentation that is not disclosed by the directors, then the auditors have a duty to disclose it. The requirement is obviously that the auditors would go to the directors and say, we think that you need to disclose this information. That should be an incentive for the directors to disclose it, because if they don't, they're going to look bad, because the auditors are going to disclose it and questions are going to be asked. Why did the auditors have to disclose it? Why did the directors not volunteer this information? At the moment, auditors have to read other information that is provided with annual financial statements. So for example, if the financial statements go with the chairman's report, etc., the standards require the auditors to read it. Brydon actually recommends that that gets extended, and that the auditors should also read any investor presentations and basically SENS announcements. In the South African context, it would be the SENS announcements. So auditors have to also read that and then see if that is not, or comment, if that is not consistent with the financial statements. So that again extends the liability of, or the responsibility of auditors. The crux of the Brydon report is that Brydon wants to expand the definition of the audit. And this is now giving rise to a whole new profession. Where previously we had the auditing arm of the accountancy profession, Brydon now recommends a whole new profession being established, and that is called the corporate auditing profession. The corporate auditing profession will be separate from the accounting profession, not even necessarily an accountant. It could be someone else. And as you can see on this model on the screen, previously we had the statutory audit, the financial statements, and assurance provided thereon. So it's all a model of auditing providing assurance on the financial information. The new model goes a lot wider. The financial information is only one part of the information that is opined on. And the information could include a lot of other things. As you can see here on the slide, it includes things like environmental matters, government matters, etc. Obviously matters that the auditors do not express an opinion on at the moment. So the idea is that this new profession of corporate auditing would encompass a whole lot of other professionals. The financial statement auditors, as we know it at the moment, they are still part of that profession, but then we'll also bring other professions in. For example, environmental auditors, engineers, economists. They may be required to express opinion on certain sections of the audit, and then you have this new person, the corporate auditor, that signs off on the entire audit. And this corporate auditor is not necessarily an accountant. Brydon actually says that there's no argument to be made at the moment that an accountant is the best person to do that. It could be anyone else. Obviously the financial statement auditor will have to be someone with accounting background. Also important, what you can see on the slide, is that the auditor not only assures but also informs. That's a big distinction. At the moment, auditors only look at the financial statements, information provided by directors, and then provides assurance on that. Now, the auditor is also going to provide information, independent information, as I've mentioned already. Obviously, with this new profession will come completely new qualifications, because the people that are currently acting as economists, as environmental experts, etc., do not have any auditing experience. Likewise, auditors do not have experience in those areas. So it is going to be necessary to develop completely new qualifications. The whole education and training process has to be changed, maybe new degrees. The universities will have to change their degree programs. And not only do auditors have to be informed, but obviously the users also. Those people that the auditors are dealing with, management, those charged with governance, have come to expect a certain level of communication or work from the auditors. They then also need to be educated to think differently about what to expect from their auditors. Brydon even goes as far as to say that the auditors have to have compulsory forensic audit training. Now from that you can see that the emphasis is changing from auditors being just skeptical to being a little bit more suspicious, because auditors have to have forensic audit training, really investigation skills and more legal skills than what auditors have at the moment. So the corporate auditing profession is going to look completely different to how we know the profession at the moment. This new profession is going to be principles based. There will probably still be standards as far as the separate parts of the profession are concerned. For example, audit of historic financial information will still have standards. But encompassing all of that, Brydon says there should be a series of principles of corporate auditing. I'm not going to go through those principles now, but we will put it on the screen, then you can have a look at it. But you can see that they include broad principles like ethics, integrity, the qualification of auditors, objectivity, skepticism, judgment, all those broad principles of auditing. Brydon wants to make them into principles of corporate auditing, and then these principles should be the principles against which an auditor is judged. If anything goes wrong, or if someone is questioning or reviewing your work, they should look at the principles, and if you have complied with these something like 10 or so principles, then you can probably say that a good audit, a good quality audit has been conducted. Brydon does have a section that deals with audit quality, and it defines audit quality as an audit that has complied with these principles, that has complied with ethics, etc. There's not a lot about audit quality, but basically he says that if the principles of corporate auditing have been followed, then we have actually achieved audit quality. Some other duties on this new auditor. First of all, the audit report is going to change completely. The idea is to make the audit report much more informative, even more informative than the current audit report is after all the changes. For example, auditors are expected to comment on how they took into account any external signals. So let's say, for example, there's some press reports about a certain industry experiencing economic pressure. The auditor obviously takes that into account in the audit plan, but that's not communicated to anyone. So the recommendation now is that those external signals should be, once the auditor takes into account, that should be communicated in the audit report. And obviously we need to know what those signals are. So Brydon is also recommending that maybe the regulator or someone should come up with a list of signals that should be consulted. And we can find that in textbooks already, and it's in some of our codes already. Another interesting thing is, as an auditor, you work in a business and you find that you experience a little bit about the business's culture. Maybe the business is aggressive, conservative, is trying to get profits, trying to grow, whatever the culture is. Now, that culture may not necessarily be reflected in the annual report. So if the annual report displays a certain culture, let's say, for example, the annual report says that we are conservative, but that is not the auditor's experience, then the auditor is required to comment on that inconsistency in culture. And that's a very difficult one. The Brydon report also considers the principle of graduated findings. At the moment, an audit is either the opinion is fairly presented, financial statement is fairly presented, or it's not. So it's a binary opinion. It's either on or off. It's either fair or it's not. Now, there's a whole lot of debate about should the auditors maybe give a graduated opinion, say how fair it is. Brydon is not in favor of that. Brydon is still in favor of the binary opinion. But what he does say is that auditors should give more information about their findings. So for example, let's say that you spent a lot of time on evaluating the impairment of goodwill, and you find that goodwill is not impaired, it's fairly valued, but it is on the relatively aggressive side of the spectrum. Then the auditor should say that. Shouldn't just say that we have found that goodwill is fairly valued. We must say goodwill is fairly valued, but on the aggressive side, or it's close to impairment or something like that. So maybe give more graduated findings. No recommendation in this regard. Brydon just says we should leave it open to market forces. I think the idea is that auditors who start giving these graduated findings will start finding that people value their opinions more, and they'll get more business, and people will pay more for those opinions. So Brydon's argument is that the market will decide about that. Brydon also spends quite a bit of time on technology and the whole aspect of including in technology in auditing and big data and the availability of data and so on. And that takes him to the conclusion, why is sampling really still necessary? So if we do use sampling, his recommendation is that the auditor should say in the audit report why we used sampling and what the principles and the basis for that sampling was. That could also be something that could be quite difficult to explain to the people that are going to read the audit report. Another thing that he recommends is that we disclose the hours spent on the audit by grade of auditors. I don't think it means that it has to be broken down in individual levels of auditor, but maybe roughly audit partner, quality reviewer, etc., assistant staff, etc. The grade of auditor, how much time did they spend on the audit, and that should be disclosed in the audit report. Other things that the auditors have to communicate is, I will refer in the next slide to the resilience statement. The way that Brydon is trying to counter the concerns about going concern and all of that is that he is going to request directors to publish a resilience statement. Now, auditors are supposed to read that resilience statement and then communicate any anxieties that they have about this resilience statement to the board, the company's board, but Even more than that, if the auditor believes that the company's board is not doing enough, then there must be an avenue for the auditor to communicate it to the regulator. In the UK, talking about the new AGA, in South Africa, the IRBA or something like that. Also, there's a recommendation that alternative performance measures be audited. As you know, in company annual reports, then they sometimes show alternative performance measures like EBITDA and things like that. Things that are not necessarily audited, or even tonnage mined or things like that. Now, those are not audited. He recommends that if measures like that are material for in understanding the information, they should be audited. Even further than that, directors have key performance areas on which they are measured. He also says that directors' key performance areas, KPIs, should be audited by auditors. And also, a big emphasis is placed on communicating the reasons for changing auditors. When an auditor leaves, what are the real reasons behind the auditor either resigning or being dismissed, or simply deciding not to re-tender for the audit? What are the reasons for that? And the auditor must have an option to explain those reasons carefully, and there's a whole lot of recommendations of exactly what questions the audit committee should ask of the auditor to ensure that those reasons are clarified and explained, not only to the audit committee but also to the shareholders at that level. The Brydon report also looks at the wider ecosystem of financial reporting, not only the auditors. So there are some duties on directors and specifically audit committees. There's some new statements. Some of the statements are new in the sense of we don't have it in South Africa. Remember, this report is aimed at the UK. Some of the statements we already have in South Africa. For example, the directors are required to publish a public interest statement. So basically a statement saying they recognize that the duty of the company is to act in the wider public interest, and how did the company discharge those duties. Also, the directors are required to issue a risk report. I'm going to go back to that a bit later on the next slide. The directors are also required to publish their audit and assurance policy. This is an interesting one because directors are going to be able to decide how much and exactly what needs to be audited. Even not only audited, some aspects have to be reviewed. The directors have to set a company policy on what they are going to have audited, by whom, when, how often, what level of assurance, etc. And that is going to be done in an audit and assurance policy that the directors prepare for the company. It's a long-term thing that keeps changing every year, and that is published so that stakeholders obviously know what the director's policy is regarding audit and assurance. Also importantly, he mentions that employees should have input into the content of that audit and assurance policy. There is also a recommendation that the directors should report on the actions that they have taken to prevent and detect fraud. So coming back to the principle of fraud again, is enough being done to prevent and detect fraud? Obviously the directors are going to make this statement and the auditors are going to comment if they disagree with any of it, or if anything is missing, the auditors can add the information. Also, the directors are going to be required to communicate all disagreements that there were between auditors and management. Now, you find often that there are always disagreements between auditors and management. There are debates, and most of the times these debates are resolved. However, when a debate reaches the stage of the audit committee is required to report on those debates, report on how they were resolved. Even if they were resolved or not resolved, it still has to be reported on by the audit committee. Then I mentioned that resilience statement, where the directors are required to issue a resilience statement. Basically, there are requirements for the directors to comment on the resilience of the company in the short term, in the medium term, and in the long term. Obviously, what they can do in the short term is much more than what they can do in the long term, so the requirements are different. But the point is that the directors have to publish a resilience statement. Again, this statement is going to be read by the auditors, and auditors are going to comment on it if there is something inconsistent with the auditor's knowledge. Also, a requirement is that the audit committee minutes of the audit committee must be published within a certain period of time. It is allowed to be redacted because it goes without saying that there will be some confidential information in there that is market sensitive or whatever. So it can be redacted, but it has to be published for stakeholders to understand what the deliberations were. There are also requirements on shareholders or investors. They are encouraged to engage more effectively. We know that with the exception of some stakeholder activist groups, the communication between shareholders, audit committees, boards, auditors, etc. is not necessarily what it should be. It happens often that there's a big corporate failure and some shareholder goes, but we could have seen it coming. We have known about it all along. We reported it, but it wasn't acted on. So Brydon is addressing that and saying that there should be a more effective way of communicating from stakeholders, from shareholders specifically to the audit committee, even to have an avenue where the stakeholders can communicate with the regulator. They can go to the audit regulator and say, we think that more attention needs to be paid to this, or that the audit is not achieving the appropriate quality, etc. The stakeholders, the shareholders, are also going to get an opportunity to comment on a risk report that is issued by the directors. I mentioned it in the previous slide that the directors have to assess the risks, the audit committee have to assess the risks that the company is facing, and then obviously they act on it. That's nothing new. Directors do it already, and the auditors have their own risk report and they respond to that. But now the requirement is that that risk report has to be published not less than 6 months before the committee meeting at which the auditor is reappointed. 6 months before, the directors have to publish their risk report. Then the shareholders can read that risk report and see what they think of it. And if they think that the directors and or the auditors should pay more attention to certain risks, or I suppose less attention to other risks, then they should have the ability to communicate it, to make recommendations to the directors and the auditors. The directors and the auditors must then consider these recommendations, and if they decide to reject the recommendations, they must also give reasons why they are not accepting the recommendations. So the shareholders will now have almost direct input into the risk report and into the risk responses of both the directors and the auditors. There are also a few discussions about audit fees. As we know from changes in the ethics codes, etc., audit fees have a big impact on audit quality and resulting maybe failures, etc. So there's a couple of discussions. For example, one is that we must recognize that audit fees are not an overhead. It's a part of actually running the business. So Brydon is actually recommending that audit fees should be disclosed in the income statement, but below the line, together with dividends. It's actually part of the corporate responsibility of the company, not part of running the business. Obviously, there's some questions there as far as IFRS compliance is concerned, or whatever the framework is. Frameworks do not normally allow audit fees to be disclosed after profit. So there will need to be some sort of reconciliation or something to comply with the framework, whether it is IFRS or whatever framework it is. Also, as far as audit fees are concerned, how are audit fees negotiated? When audit fees are negotiated, Brydon recommends that the only person who's allowed to negotiate audit fees with the auditors should be the audit committee chairman. The audit committee chairman can negotiate the audit fee. If it's not negotiated by the audit committee chairman, it's not valid. It obviously has to be approved by the board later, but the negotiation by the audit committee chairman to make sure that that relationship is moved away from management. He expresses the concern that there's still many cases where the auditor sees management as his client, and that's not correct. The client is the shareholders and their proxy, the audit committee in this case. The audit committee should negotiate. But not only that, in the audit firm, who is the person who negotiates with the audit committee? Generally, at the moment, it is the engagement partner that negotiates with the audit committee. Brydon says that that creates a self-interest threat as well, and he recommends that that be separated. Audit firms should have a separate department or a function or a committee that negotiates audit fees with audit clients, so that that pressure is taken off the engagement partner. As far as the firm itself is concerned, there's a few recommendations regarding the culture of the firm, etc. But the two main ones are, as far as audit liability is concerned, Brydon realizes that audit liability at the moment is not conducive to good, the audit liability regime is not conducive to good quality audit, because auditors don't want to go beyond what the standards require because they are worried that they're going to get sued, and they sometimes get sued even for something that is not their fault. So auditors are maybe over careful, and maybe audit quality isn't what it should be. So Brydon is just saying that the regulator should engage with all the stakeholders and try to facilitate a much better liability regime. Try and find some way that works better than what it is at the moment. Also, the audit firms, when they report on their own information, he says that we should separate the financial information for audit from other functions. There is this perception that audit is subsidized, and maybe not a perception, maybe it's true, that audit is subsidized to an extent by other services. Auditors should report on audit departments separately as a standalone department so that it can be obvious to what level it is subsidized if it is the case. This was just a short summary of the Brydon report. Brydon report contains something like 63 or 64 recommendations. Some of them are relatively easy to implement. Some of them we have in South Africa already. Some of them are difficult. Some of them require significant groundwork to implement. The next step is that the UK government is now going to take it forward and investigate further, and then there will probably be some recommendations as far as the UK is concerned, and then probably the rest of the world will follow to the extent that we are not there yet. So we're looking forward to it, and I would encourage that you get hold of the Brydon report and try to follow the debate and try to be part of the debate.